Picture this. It's July 2025, and you're looking at global shipping lanes.
Right.
Specifically, you're watching these massive supertankers leaving the ports of Saudi Arabia. Now, according to Bloomberg's tank tracking data for that specific month, if you follow the ships heading east to China, they are carrying 1.74 million barrels of crude oil every single day.
Which is just a staggering volume.
It is. I mean, that is the highest single-month volume Bloomberg has recorded since they started tracking this metric back in 2017. But if you look at the ships heading west to the United States, that number completely plummets.
That falls off the cliff.
Exactly, down to just 161,000 barrels a day. That is the absolute lowest point in that exact same 8-year window. So, welcome to today's Deep Dive, everyone. We are unpacking a massive stack of intelligence briefings today because, well, this isn't just shipping data.
No, not at all.
It's the footprint of a quiet structural earthquake in global finance. And to help us unpack this, I've got our resident expert here.
Hey there. Glad to be here. And, to really understand the stakes for you, the listener, you have to look way past the crude oil itself.
Right. The oil is just the surface.
Exactly. We are looking at a massive structural signal that involves the foundational architecture of the U.S. dollar. That architecture is, it's what ultimately dictates global inflation.
It's your purchasing power.
Yeah. Quite literally the value of the money sitting in your bank account right now.
It's huge. And the sources we're diving into today, we've got analysis from Chatham House, the Quincy Institute, the IMF. They detail this fundamental recalibration in how Saudi Arabia operates between Washington and Beijing.
It's a total paradigm shift.
It really is. But before we dive into the mechanics of this, I want to make a quick note on the parameters of our deep dive today.
Yeah, super important context here.
Right. So the intelligence and historical data we are looking at, it obviously touches on actions taken by U.S. political figures, specifically during the Trump administration in 2019 and a defense agreement signed in late 2025. We want to be explicitly clear up front. We are examining these events completely impartially.
We're just looking at the data.
Exactly. We are analyzing them purely as geopolitical data points that influenced Saudi macroeconomic strategy. So we aren't endorsing any partisan viewpoints or taking any political sides here.
No, we just follow the data to see where the money is moving.
Spot on. So let's get into it. The data tells this fascinating story about a 50-year-old system that is currently fracturing.
It is. And to grasp the gravity of that July 2025 shipping data you mentioned, we have to establish our historical baseline.
The 1974 agreement.
Yes. The current global financial paradigm was essentially forged in 1974. Secretary of State Henry Kissinger was scrambling, really, to find a new anchor for the U.S. dollar.
Right, because of the 1971 shock.
Exactly. The U.S. had finally abandoned the gold standard. So the dollar was facing its first serious existential challenge as the world's reserve currency.
It was just fiat paper at that point.
Yeah, just paper searching for a foundation. So in 1974, Kissinger struck this brilliantly strategic arrangement with the Saudi royal family. And the geopolitical climate of the mid-70s is crucial to understand here.
The Cold War is raging.
The Cold War is raging, Soviet proxies are highly active in the Middle East, and regional stability was, well, incredibly fragile.
And Saudi Arabia had all this oil, but they didn't really have the military to defend it.
Right. They possessed immense petroleum wealth, but lacked a formidable military deterrent. Meanwhile, the U.S. had the world's most powerful military, but desperately needed economic stability.
It was a perfect match, though the fact-checkers at Radio Free Asia pointed out in our research that this was never actually a formal signed treaty, right?
No, it wasn't. It was an informal handshake agreement.
A handshake that dictated the global economy for the next half-century. So the deal was the United States provides military protection and advanced weapons to Saudi Arabia.
And in exchange,
Saudi Arabia agrees to price its oil, all of its oil, to every single buyer on the planet exclusively in U.S. dollars.
Which completely solved the existential crisis of the U.S. dollar. I mean, it essentially backed the dollar's reserve status with global energy demand.
Because everyone needs energy.
Exactly. If any nation on Earth, Japan, France, South Korea, if they wanted to power their factories or heat their homes, they had to acquire U.S. dollars first.
I like to think of it like an exclusive global VIP club.
Oh, that's a great analogy.
Right. Like, if you want to go to the bar and buy a drink, and in this case, the drink is the energy required to literally run your country, the only way the bartender is going to serve you is if you pay with the club's specific tokens.
Which are U.S. dollars.
Exactly. It guarantees massive, endless global demand for those tokens. You literally can't participate in the global economy without them.
And the elegance of the system goes even deeper because, think about it, these foreign nations needed massive reserves of dollars on hand to buy oil.
Right. Yeah, they couldn't just buy them on the spot every time.
Right. So where do they park those dollars?
Yeah.
They put them in the safest, most liquid asset available, which is U.S. Treasury bonds.
Wow, so it feeds right back into the U.S. government.
Completely. The petrodollar system didn't just ensure currency dominance. It created this perpetual machine that financed U.S. government debt. It allowed the United States to run deficits that would have bankrupted other nations.
Just because the world was forced to buy U.S. debt to get access to energy?
Exactly.
Okay, so looking at the timeline in our research, the absolute trust in that VIP arrangement held firm for decades until a very specific moment.
September 2019.
Yes, the 2019 Abqaiq attack. That seems to be the exact moment the math changed for Saudi leadership.
It was a total watershed event. Iranian cruise missiles and drones struck Saudi Arabia's most critical oil processing facility.
And the impact was massive.
Unbelievable. It temporarily knocked out roughly 5% of the entire world's daily oil supply.
5%.
Yeah, the largest single disruption to global oil infrastructure in modern history. Now, for 50 years, the implicit understanding was that an attack of this magnitude on Saudi oil infrastructure would trigger an overwhelming U.S. military retaliation.
But that's not what happened.
No, it wasn't.
The U.S. response was incredibly muted. The analysts at the Quincy Institute specifically described the U.S. posture at the time as indifference. They didn't retaliate militarily.
And the message to Riyadh was unambiguous. The U.S. security guarantee had a ceiling, and that ceiling was much, much lower than they had historically assumed.
Going back to our analogy, it's like if the bouncer of the VIP club just stands there and won't actually step in when someone attacks the bartender.
Right. The fundamental premise of the 1974 agreement is broken at that point. And this realization birthed a new Saudi strategy. The Quincy Institute analysts actually coined a term for it. They call it workarounding.
Workarounding. I like that. And the physical manifestation of that workarounding becomes glaringly obvious when we look at what happened in June 2024.
The expiration.
Yeah. That 50-year informal petrodollar arrangement was quietly allowed to lapse. It just expired.
No press conferences, no dramatic announcements.
Nothing. Just quietly let it die. And as of that moment, Saudi Arabia became structurally and legally free to price and settle oil transactions in any currency it chooses.
Now, a dramatic divorce is historically very bad for business, especially in global energy markets. So the goal wasn't to immediately sever ties with Washington.
Right. They didn't just burn the bridge.
No. The strategy was to systematically construct a parallel financial and diplomatic infrastructure. That way, Riyadh would never find itself entirely dependent on a single superpower ever again.
And just look at where the money is flowing to build that parallel infrastructure. I mean, the numbers and the sources are wild. In 2024, bilateral trade between Saudi Arabia and China hit $107.53 billion.
That's more than double the volume of just a decade ago.
Making China their largest trading partner by a massive margin. And it's not just trade. In just 1 year, Chinese foreign direct investment into Saudi Arabia shot up almost 30%.
Pouring over $8 billion into the country.
Yeah. By September 2025, they were signing dozens of investment agreements. Smart vehicles, medical devices, green hydrogen. It's a massive pivot.
But the trade volume is really just the surface layer. If we want to understand how this geopolitical independence is being engineered, we have to look at the financial plumbing.
The actual mechanisms moving the money.
Exactly. In November 2023, the Saudi Central Bank and the People's Bank of China established a $7 billion yuan-rial currency swap.
Okay, break that down for us. Why does a currency swap matter?
It's a vital mechanism. It allows trade between the two countries to be settled directly in their own local currencies.
Completely bypassing the U.S. dollar.
Entirely. No dollars needed. But the most fascinating part of that plumbing upgrade is Project mBridge.
Right, Project mBridge. Now, a lot of listeners are probably familiar with SWIFT, right? The Western-dominated financial messaging system.
Sure. For decades, if you wanted to move massive amounts of money across borders, you use SWIFT.
But SWIFT has a catch.
A big one. SWIFT functions a bit like a game of telephone. When money moves from Riyadh to Beijing using SWIFT, the transaction often has to hop through a U.S. correspondent bank to clear the dollar settlement.
And that hop is the vulnerability.
Exactly. That specific hop is what gives the U.S. government jurisdictional power to monitor or even sanction the transaction.
Which Saudi Arabia realized they needed to avoid after 2019. So how does Project mBridge fix this?
Well, Saudi Arabia fully joined mBridge in June 2024. and it fundamentally alters the process. It's a cross-border central bank digital currency platform.
A digital ledger.
Yes. Instead of messages passing through multiple Western correspondent banks, mBridge acts as a shared digital ledger. The Saudi and Chinese central banks can essentially hand digital cash directly to each other, instantly.
So there is no Western middleman.
None. There's no one in the middle able to view, delay, or sanction the transaction.
That is massive. And yet adoption is already happening. By early 2026, mBridge had already processed $55.5 billion in wholesale international payments.
Combine that with Saudi Arabia's induction into the BRICS bloc, and the parallel architecture is undeniably operational. It's live.
Okay, I hear all that. But let me play devil's advocate for a second here.
Go for it.
Let's look at a seemingly contradictory data point from our research. In November 2025, Crown Prince Mohammed bin Salman signed a strategic defense agreement with the U.S.
Right, the big arms deal.
Yeah. Saudi Arabia secured F-35 fighter jets and 300 U.S.-made tanks. So, on the surface, doesn't that look like this whole pivot to China narrative is a bit overblown? Like Riyadh is simply retreating back under Washington's security umbrella?
I get why you'd say that. That is the common surface-level assumption. But when you dissect the actual parameters of the agreement, which Bilal Y. Saab did for Chatham House, a totally different reality emerges.
How so? What did Saab find?
Saab notes that while Saudi Arabia secured advanced weaponry, the agreement crucially stopped short of a mutual defense guarantee.
Oh, interesting.
Yeah, it lacked the explicit NATO Article V style ironclad promise that Riyadh had been actively seeking since the 2019 Abqaiq attack.
So no guarantee that the U.S. will actually step in and fight for them.
Exactly. Elizabeth Dent at the Washington Institute for Near East Policy echoed this exact same assessment. This isn't a zero-sum game where an ally chooses the U.S. over China.
It's a balancing act.
More than that, this is an ally successfully collecting immense geopolitical dividends from both sides. They are leveraging that new parallel infrastructure to extract better terms from Washington.
Okay, that makes a lot of sense. So if this parallel system is fully live, we've got the currency swaps, the mBridge digital ledger, the BRICS membership. The obvious question is, why hasn't the dollar cracked yet?
That's the million-dollar question.
Right. And the data from the IMF shows a massive anchor that is still holding the status quo in place.
The currency peg.
Yes. The Saudi currency, the rial, remains firmly pegged to the U.S. dollar at a rate of 3.75, and the IMF's August 2025 consultation explicitly stated that the peg remains appropriate.
And you have to look at the reserves. The Saudi central bank, SAMA, is sitting on a war chest of $451 billion in foreign exchange reserves.
And what currency are those reserves mostly in?
Overwhelmingly held in U.S. dollars.
Wow. So they can't just tank the dollar.
No, absolutely not. Breaking the peg or intentionally triggering a collapse in dollar demand would immediately devalue their own massive reserve holdings. They have a deep vested interest in preserving dollar stability in the short term.
Plus, there's the analysis from S&P Global pointing out some severe practical limitations of actually using the Chinese yuan for global oil settlement.
Right.
It seems like they have the plumbing built, but they aren't pushing massive volume through the pipes yet.
Because shifting a globally traded commodity market requires profound structural trust. And honestly, that's something the yuan currently lacks.
Why is that?
China maintains incredibly strict capital account restrictions. The People's Bank of China tightly controls money moving across its borders to manage its domestic economy.
Oh, so the money gets trapped.
Exactly. If Saudi Arabia takes payment in billions of yuan, they cannot simply take that currency and freely invest it in, say, European real estate or Japanese technology. Their capital becomes geographically restricted.
Whereas the U.S. dollar is completely liquid.
Despite all its geopolitical baggage, the dollar remains universally accepted.
It's remarkably similar to a personal finance scenario for our listeners. Imagine keeping your primary checking account open at your old bank because your mortgage is tied to it.
Right, and your salary gets direct deposited there.
Exactly. And the sheer administrative hassle of moving everything all at once is just overwhelming. But, and here's the kicker, because that old bank completely ignored a fraud alert on your account a few years ago.
Which is our 2019 Abqaiq catalyst.
Yes. Because of that, you've secretly gone and opened a fully functional offshore account with a totally different bank.
And you haven't moved your life savings over to the new offshore account yet. The balance is small.
But the infrastructure is built.
The routing numbers work, the debit card is activated, and for the first time in your life, you possess the mechanical ability to walk away if your primary bank ever fails you again.
That is exactly where Saudi Arabia is sitting right now. So we have the old bank account and the new offshore account. Looking at the projections from our sources, there are three clear scenarios for how this dual account system plays out over the next few years.
Yeah, let's walk through those trajectories. The first one is the most probable trajectory through 2027.
Which is just a continuation of this dual track hedging, right?
Exactly. The status quo remains, but it intensifies. Saudi Arabia maintains the dollar peg and keeps its reserves in U.S. treasuries.
But they don't slow down with China.
Not at all. Simultaneously, they aggressively deepen trade with China, with projections suggesting bilateral trade could hit $120 billion annually by 2027.
So we'll see yuan-settled oil trades grow incrementally.
Right, mostly through the mBridge system, basically testing the plumbing.
Okay.
But it'll remain a relatively small fraction of total global sales.
If they are hedging their bets, a slow burn makes total sense. But equilibrium eventually breaks. Based on the Quincy Institute data, it seems like a second Gulf security crisis is the only thing volatile enough to actually force their hand.
And that brings us to the second scenario. That is exactly the tipping point scenario the analysts highlight.
What happens then?
Well, if there's another major attack on Saudi infrastructure, and the United States once again fails to respond credibly, Riyadh no longer has to scramble to figure out a response.
Because the offshore account is already open.
The infrastructure for an accelerated pivot is completely built. If Saudi Arabia decides in that moment of crisis to redirect just 20% of its China settlements into yuan,
Just 20%.
just 20%, that represents roughly $21 billion in non-dollar flows annually.
Wow.
It would mark the definitive beginning of the petrodollar's unwinding.
Which leads us to the worst-case scenario outlined in the research. This involves a major military confrontation in the Gulf, coupled with an explicit U.S. non-response.
A total breakdown of the security pact.
Right. And this triggers a formal strategic decision by Riyadh to redirect the majority of China-bound oil through yuan-denominated settlement.
And keep in mind, China receives 14% of all Saudi crude. Saudi Arabia is the world's largest single oil exporter. A formal shift of that magnitude would be the first major break from the dollar pricing convention since 1974.
What would the macroeconomic fallout of that look like?
The immediate result would be immense speculative pressure on the rial's dollar peg. That $451 billion reserve buffer would be tested aggressively as global markets attempt to literally price in the death of the petrodollar.
Bringing this all the way home to you, the person listening to this deep dive right now, this macro geopolitics directly impacts the cost of your daily life.
Absolutely.
The value of the U.S. dollars in your pocket is intrinsically tied to the global demand for them.
Right. For 50 years, the VIP Club monopoly guaranteed that demand. But if parallel systems like mBridge succeed and global demand for dollars structurally drops, what happens?
Those dollars have to go somewhere.
Exactly. They eventually come flooding back into the U.S. economy. That increases the domestic money supply, which structurally drives up inflation.
It alters the cost of imported goods.
It forces the Federal Reserve to adjust interest rates.
Which means it directly impacts the rate you pay on a mortgage or an auto loan.
It touches everything.
It really does. You know, the history of global finance shows us that reserve currencies usually don't collapse in a single catastrophic event. They erode.
Slowly at first.
Yeah, slowly at first through currency swaps and digital ledgers, and then all at once during a geopolitical crisis.
The structural foundations that guarantee U.S. economic supremacy are undeniably being rewritten as we speak.
So synthesizing everything we've unpacked today from this massive stack of intelligence, the core revelation here is not that Saudi Arabia is actively breaking up with the United States today.
No, they're not intentionally throwing away a 50-year security relationship.
Rather, they have successfully built the operational infrastructure to ensure they never, ever have to ask the United States for permission again.
The workaround is fully complete.
It is.
And I think it forces us to look past the crude oil itself and really examine the ultimate byproduct of the petrodollar system, which is U.S. Treasury bonds.
The government debt.
Exactly. For 50 years, foreign nations had to acquire dollars to buy oil, and they parked those dollars in U.S. government debt. That forced artificial global demand is a massive part of what has allowed the United States to run multi-trillion-dollar national deficits for decades without bankrupting itself.
It's the perpetual debt machine.
Right. So I'll leave you with this thought. If the mBridge system scales and that forced global demand for dollars structurally declines, who is going to finance the U.S. government's deficits tomorrow?
Definitely something to mull over the next time you see headlines about foreign policy. Or, honestly, just check your own bank balance. Thank you for joining us on this deep dive. Keep questioning the surface level narratives, keep looking closely at the data, and we will catch you on the next one.